Welcome to the High Value Sales Show of Eversprint.com. I'm Malcolm Louie, the managing member of Eversprint, and today we're speaking with Adam Stettner, the CEO of Reliant Funding, a provider of funding to small and medium-sized businesses. Welcome to the show, Adam.
Thank you, Malcolm. It's great to be here.
Adam, you grew your company's revenue from $9.7 million in 2014 to $55.4 million in 2017, a 469% increase, and in 2018, you hit over $60 million. Before we talk about how you grew your company so fast, can you briefly share what your company does beyond my quick intro and how your company differs from the competition?
Sure, it's a good question. Thank you. So Reliant Funding provides capital to underbanked small and medium-sized businesses. And the term underbanked might be a bit cliche. The way I would define that is small business is typically approved with banks at a rate of approximately 20%, which means two things. First, there are 80% of small businesses that are seeking capital or in need of capital that are not being approved by traditional funding sources. And the other 20% that is approved, oftentimes, while the bank terms are very favorable in terms of cost and term, the amount of work that it takes and the time that it takes to get funding is sometimes onerous. And so we seek to service both the population in need of the bankable population in need of funding, but those that need it quickly, and also the underbanked segment, the 80% that are typically declined.
Okay, got it. And how do you differ from other companies that also provide funding to small and medium-sized businesses?
Well, I would like to say we could use the whole interview for me to describe that, but if I had to summarize that with a short answer, I would give it in just a few ways. First, we are genuinely interested in each individual company's story. And by that, I mean how long they've been in business, where they're located, the industry that they're in, what they're looking to do with the capital that we're providing them. We listen. We look at their cash flow, both in and out, and determine based on the story and the story both that the owner tells and then the story that the financials or the cash flow statements tell. We determine what we're willing to provide based on that story. And I think all too often, funding is provided, whether it's business funding, at this small business funding or large lines of credit, is predicated on revenue, FICO, credit profiles and files, and very little attention is paid to how is the money being used, what will that do for the business, and what kind of payment can actually be afforded predicated on cash flow. That's a big one. Another a big one is relationship. We are absolutely relationship driven. Although we automate a lot of our process, we still want to make sure that our clients feel that they have a long-term relationship. And by that, I mean a renewable source of capital. So we are not a one and done source of funding. We certainly can be, but the majority of the small businesses that fund with us come back to us for subsequent funding. And I think both the cash flow derived determination of funding amount, the story in guiding how we underwrite and look at funding amount, and the relationship driven or that renewable source of capital are all areas of difference. I could speak, of course, to technology and turn time, deliverability, and accessibility, et cetera, but I think that those are the big differentiators.
How much of your decision to lend capital to a company is qualitative versus quantitative?
I would say that it's a balance. It really is a balance. We are looking at financial attributes, but those attributes are not necessarily the traditional. In other words, FICO, while it's something of interest, we're much more interested in what made the FICO score look like it does. So, for example, how many trade lines a business might have, whether or not they're overextended, what the inflow and outflow of cash looks like. But then the other side of that is how long have they been in business and what are they seeking to do with the money. And if I think all too often the reason small business is underserved is too many funding sources look purely at a FICO score, and they have a credit profile that says if the FICO is below X or the revenues are below Y, it doesn't fit their box. What we're really trying to do here is figure out how to make our model fit the client's box. Every small business is different, and they really are. They're driven and run by small mom and pop entrepreneurs, whether they have one location, 5 locations. The concept of a traditional consumer credit profile or large business line of credit scenario, it really doesn't work for small businesses that are cash flow driven. So if we look at cash flow and we look at a list of attributes and we apply then use of capital and the intent of the use of the money, it tells a much fuller story, and we find great success with that.
Is it accurate to say that the bigger the lender, the more quant driven they become, just simply because they don't have the time nor perhaps the inclination to take as close of a intimate look into the borrower?
So the larger we've grown to be what I would consider significantly larger than we were. And along the way, we've brought automation where it helps with data-driven items. So for example, analysis of bank statements, we can automate that. But I really think there's always the opportunity for the client to be able to explain the story. Now, if a client doesn't want to tell their story, there's no need. They don't have to. But you can imagine that it makes it a lot easier for us if we have an understanding of how they plan on using the capital. For example, someone that is going to expand a location. Let's use a restaurant as a random example. If they're going to add 40 tables, you can discern with their assistance what that will do to their revenue. They may need the money to do the renovation or need the money to get the permits. And it may be a period of time before that revenue begins. But together we can determine what the right dollar amount is, what the comfortable payment plan will be for them, and when that revenue will begin. Now, if we didn't get that story and we only heard that they wanted, let's say, $50,000, and we took that and underwrote the $50,000 file without knowing how it was going to be used. For example, that the $50,000 investment would yield over the course of a year, 600,000 more in sales. The 50,000 may not look quite the same. And so, but there is a way to automate a lot of the what would otherwise be arduous, automate that, make that process quite easy, both for our prospective client and for our sales and underwriting teams. And then really just make the conversation about the story. Now, if the story is not given, it's still easy to write or underwrite a file based on the data. But again, it's the client's choice. If they want a relationship and they want to speak and they want to be heard, we want to listen, and we will respond accordingly. If they don't, there's no punitive piece that comes with it. We will just underwrite based on the facts that we've got. But that we've scaled. I mean, at this point now, we funded approximately $1.3 billion to American small business. And in our first year, we funded $1 million. And so last year was nearly $250 million. And so I think there is a way to scale if you automate the areas of the process that don't require the relationship or don't require or at least offer input from that prospective small business owner. Right. I hope that makes sense.
It does. But like say the huge banks in the world, right? The JP Morgan Chases of the world. How does their process of lending to a small, medium-sized business differ from yours?
Well, I won't speak specifically to JP Morgan Chase, but in general, large banks, they have a profile, and either a client, it doesn't matter small business or otherwise, You can be a mortgage client, an auto finance client, a credit card client, a home equity line client, you name it. Whatever the product is, they develop profiles associated with each. That profile may come with different rates, different max funding amounts, different terms, but you either fit into the bucket or you don't. And so that's the traditional way to fund anyone, consumer or business. You build a risk model, you create a profile, and then you build product around those profiles, or vice versa. You create a product and then build your profile. For our business, we have general, like what I would call the core, or if you can use the analogy of almost like the like stone fruit, a peach. The pit would be our credit policy, but the fruit itself would be the story around it. So it's not so much black and white. The pit might be black and white. In other words, we might not go below gross annual sales of X, or margins of Y, right? We want to make sure that the money is not burdensome to the prospective client. But beyond that, there is this softer piece of the fruit where we want to hear the story and we want to adapt our model to fit the client need. Because the truth is, if it doesn't end up working for them, in the long run, it's not going to work for us either. Banks have cheaper cost of capital, and they have scale that a company like Reliant Funding doesn't have. It's a lot more important that we service our clients, and rather than making them come to us, it's important that we set risk parameters that we're comfortable with, and then we take those and we go to them. And I hope that answers your question.
Yeah, it does. Now, the larger banks, they do it the way they do it simply because the volume is too high, and hence they really can't spend the time that you're able to spend learning more about the customer. Is that the driving factor?
Well, I think to a degree, yes. But banks are a terrific option for small business. My role at Reliant Funding is primarily to serve the underbanked. In other words, if you can get an amazing offer from the bank, I think it's terrific, and that's where you should go. And for those that are bankable but need the money quickly, we can fund next day, where the bank might take 6 weeks. And then it's simply a matter of that business owner determining whether or not time, because all money has time value, if the time is more valuable than either the cost, the term, or the accessibility. But the other part of your question, Malcolm, is banks have deposit accounts. And so they're making money in numerous ways. Reliant Funding, all we do is provide capital. We don't take deposits. We are not a bank. And so oftentimes a bank will use a financial product like a loan to also initiate opening a large deposit account. And if a business can park 6 figures, or in some cases 7 figures, and also open then additional secondary, tertiary lines of credit, revolving lines, it ends up becoming this multi-pronged source for the bank of revenue.
Right.
And so they build these products very firmly, and they say, we offer these products with the idea that oftentimes they will even lower the rate in order to obtain, if you have a deposit account, if you deposit a certain amount each month, et cetera, they'll alter their product profile or their credit profile. And so they intertwine these things. But yes, their model is very different. And candidly, it's highly scalable. It's also very fixed.
Right. Now, how do your rates typically compare between a bank and what you're able to provide your customers? About the same? Are you higher? Are you lower?
Well, we do not charge an interest rate. We charge a fixed factor. So we're more akin to factoring or the sale of future receivables than we are a loan. We don't charge an interest rate. There is no compounding or accrual of fees with Reliant Funding. If a client were to fund for X amount of dollars, they know their repay will be X times a factor of Y, which would equal a total repay of Z. It's a simple mathematical equation. So unlike a traditional loan, that compounds and accrues an interest rate, we use a factor. And in essence, you could view that as a discount on future sales. And so it's not an apples to apples comparison, but it's very simple to understand. What we do is we provide the funding on day one, and on day two, we then break out the repay across daily small payments. What we found is that small businesses are purely cash flow driven. And that's whether they're a small business doing 100,000 a year in revenue, 5 million, 8 million in revenue, they're all cash flow driven. And our culture, both consumer and business, we're payment driven. With small businesses, for them to have, let's say, a $2,000 monthly payment versus $100 per day across 20 business days in a given month, Monday through Friday, almost every small business we spoke with preferred this concept of the predictable, small daily payment, because that works a lot better into their cash flow than the end of the month $2,000 payment. So what we did was we came up with this concept of factoring or sale purchase of receivables. And for small businesses, we're buying future sales at a discount, much the way a factor would purchase a PO, a purchase order, at a discount for a sale that's already occurred. With our product, we're purchasing future sales that often haven't occurred yet. We're just purchasing them at a discount today. We're giving them all the money for the sales that will occur over a given period of time, and then we're discounting that by an agreed upon percentage. And we show this in a daily payment schedule. In other words, if somebody is with us, let's say for 12 months, that might equate to 264 daily payments instead of 12 monthly payments. We would lay that out for this prospective client. Here's what you're going to be funded. Here's the factor rate. Here's the total repayment amount. And here is a schedule of all 264 daily payments. You know up front exactly what you'll be paying every day, which makes for a much more predictable cash flow presentation for a small business owner.
Right.
And again, Malcolm, I hope that answers your question.
Yeah, it does. I imagine that, of course, the borrower, the business owner, even though the payments and payments transactions, the cash flows in and out are a bit different. I imagine they will have to somehow figure it out, right? To say, yeah, is this cheaper or more expensive?
Oh no, well, we are more expensive than a bank loan, and we tell every prospective client we've got that we're more expensive. And earlier in our conversation, I recommended them. If someone is approved by a bank and they're able to wait the 6 weeks, which is a typical time frame, sometimes faster, sometimes longer, but that would be my recommendation as an individual, is that bank money is great money. But again, the reality is if you look at 1,000 businesses, 800 of them will struggle to obtain bank funding. And yet all 1,000 at some point will need capital. And so the concept here is that we're there to service, completely transparent about cost of capital and how our schedule works. But when time permits, those that are approved by a bank, it's tough to beat a bank. It really is. So I don't really view us as competing with banks. I view Reliant Funding as augmenting banks.
Right. Okay. Now, can you give me maybe a rough idea as to how much more expensive capital from Reliant is versus a bank?
So a bank loan will typically range from very low double digits to high double digits in terms of interest rate. But with compounding and accrual, the reality is if you wanted to look at it as simple interest, it looks more like the 20s. Right, with compounding and accrual. And look, if you could get in this example, it wouldn't apply if you were able to get a bank loan at 3.9%. Now, very few, if any, small businesses are getting bank loans at single digits. But if they were able to do that, then the math I just gave would not be applicable. But low double digits to, let's say, mid-high double digits with compounding and accrual would be in the low or so 20s with the compounding and accrual of interest throughout a given year. And we would probably run on an equivalent basis about 30 to 40% higher cost of capital than a bank loan. Again, the products are different. We are not writing loans.
Yep.
But if you were trying to create a side-by-side comparison, our money would run, I would estimate, Malcolm, about a third higher.
Okay, so the bank loan was 20%, for example. Your funding, if you could make it similar, would be about 6 percentage points higher, roughly speaking.
Give or take. And again, it becomes very complicated with, you need to know the schedule on which, are they accruing and compounding on it, as the bank for that matter, accruing and compounding daily, weekly, monthly, what point in the month are they compounding and accruing, when do payments hit relative to that accrual, et cetera. And so I'm not seeking to skirt the question, because it's a phenomenal question. And it's one we address for our clients. And that's why we make it so black and white.
Yep.
We can't speak to what the bank will do, but we write down exactly, here's the amount of money that will be net deposited into your account tomorrow. The day after, here's what you'll begin paying. And here's the total that you will repay us over a given period of time. Now, even that time is flexible. In other words, unlike a bank, if our prospective business, if our business client, if their sales slow, then our repayment slows. So the term is not fixed for us, but the cost of capital is. In other words, we take a time risk that we bear with the client. If the client's business is doing amazingly well, that's great for him, and it's good for us. We get repaid as promised within what we consider to be an estimated time period. But if the client's business slows for any reason, then our repay slows as well. But our cost of capital does not go up. Again, a function of what I alluded to earlier, we do not compound or accrue because we're not an interest rate.
Right.
We're a fixed cost of capital. So for businesses that are seasonal or cyclical, we take that into account when we review financials. And again, it's all automated. It happens within minutes. So it's not as though it's an arduous process. It's not onerous for the client, and they're not sitting and waiting. But we can quickly assess cyclicality and determine what we believe the right term is. And again, just an estimate. And we account for that when we provide an approval.
Right. Now, what sort of collateral do you have to extend the capital? What do you use as collateral from the business?
So, in my opinion, I think this is where from a business owner's perspective, we become quite attractive. Unlike even a lot of our peers, because we do not write this as a loan. There is no collateral. The collateral is truly future sales. But beyond that, we're not taking pledged assets, and nor are we taking a personal guarantee. And so it's unsecured funding in the sense that we're relying on our ability to underwrite and assess risk of continuity of that business. In other words, if there's business continuity, we expect to be repaid because that means there's ongoing and future sales. But if the business ceases to exist, we bear a lot of that risk with the business owner.
Right.
And and my theory there is, Malcolm, I was a small business owner even before this, and then I started this business. My theory was, I'm on the hook for everything. I am signing every day for something. And that's incredibly stressful. And it affects my personal debt to income, and it affects the assets that I can pledge to borrow personally, whether it's for an auto loan or a mortgage or otherwise. And traditional business lending requires that same process. So my feeling is there isn't a business owner on earth that wants to go out of business. And so if you just think from a human perspective, they're not going to go out of business to get out of repaying any kind of obligation. And so I felt like the concept of advancing money against future sales made great sense because human nature is you don't want to let other people down. Of course, there's some bad individuals out there that are willing to commit fraud or do bad things, and everybody deals with it, whether it's insurance, banks, you name it. But if you look at the average business owner or the typical business owner, they're not looking to do bad things. They're looking to run their business. So if we could have a product that might cost a little bit more, but is very, very clear and transparent and omitted that requirement that banks and traditional lending has of personal guarantee and pledged assets, it would really free that business owner up to continue to live their life, both professionally and personally, without being encumbered by these PGs and collateralization.
Right. Yeah. And I think that can also, in the mind of the business owner, yes, they know that your capital is more expensive, but then at the same time, you don't have all these encumbrances that might come from a traditional loan.
That's exactly right. That's the theory behind the structure.
Yeah, well, it seems well. Looking at your revenue growth, it looks like the theory is playing out quite well.
Yeah, well, if I could add, I would say that for me, the biggest test, less revenue. The biggest test for me is repeat business, because if you're an excellent marketer and you're excellent at sales, you can grow your business, provided you have a decent product. You can grow your business. But for me, growing your repeat business is something that I take great pride in. And this year, as an example, we're striving to do just north of $250 million and 50% in funding, $250 million, and just over 50% of that will be from repeat clients. And to me, the best test of, do your clients like your product? It's even less what they say and a lot more about what they do. And the fact that they come back at a rate north of 50%, meaning for every dollar we put out on an initial file, we are renewing currently a rate of over $1.25. So it may be that on a unit basis, 1 out of every 2 clients comes back to us, but on a dollar basis, we're 125% of dollars in the fullness of time.
Nice. Now, how does that compare to industry averages for your competitors who lend money the same way as you?
It's very hard, Malcolm, because our industry, if I segregate us from traditional financing, banks are highly regulated. Many of them are public, and so all their data is also public. But in a privately held business that is not a bank, all of these things are not public record. Mm-hmm. But I believe, based on competitive analysis that we're able to do, so win-loss scenarios where we're in competitive deals, that we're competitive. We win significantly more than half the time when we're up against another source. And then our retention of renewals is incredibly high. In other words, if someone comes to us and then they approach us for subsequent financing, our take rate on an offer for a renewal is over 88%.
Nice. Yeah, my understanding is that your business can have high turnover, or not that many can have low repeat business. Someone shared with me who was in the merchant cash advance business, saying that they churn through clients quite rapidly, at least in that space.
Well, so that space is I mean, nearly identical to what I consider we do, but it's no different than you might look at the manufacturer of a given product, and someone might make a product that is manufactured out of aluminum and honed to perfection and engineered to the nines and designed to last 10 years. And someone else might make the same product that's made out of multiple pieces of plastic that's designed to last two weeks. And they're both the same product technically, but it's the quality of the product that makes a difference. And I think the way we've structured our marketing, our sales, and the way we communicate transparently with clients, and the way we work to maintain relationships, and all of those things together lead to a very different experience than they might have at a competitor. And so although the industry might be apples to apples, I think each company could be apples versus oranges.
Right. Now let's talk a little bit about your revenue. You grew from 9.7 million in 2014 to 55 million in 2017. You're over 60 million in 2018. What were the 3 drivers of your growth over those 4 years?
Well, so, and that's a great question. I appreciate it. If I could just go back, pre-14, I think it's important for your audience to know, we struggled between 2008 and I would say really 2012, 2013 to get traction on revenue growth. And so that period, the only reason I reference it, although not part of your question, I want to make sure that I make it clear that this hockey stick type growth, or what at least appears to be hockey stick type growth, came with 5-6 years of pain and difficulty in finding the formula that allowed us to go from 0 to 9 million. And then once the formula really began to work and we achieved the 9 million, it was a lot easier to scale from there. So if I only answered the question from 14 through, let's say, 18, I don't think it paints the picture as accurately as if I explain, and I don't have to explain any more other than, please trust me when I tell you going from 0 to 9 million was like getting run over by a bus every day for 5-6 years. And then going from 9 million to greater than 60 million, while not easy, candidly was a lot easier than getting from 0 to 9 million.
Right.
So before I now answer your question, hopefully that provides a little bit of background or color.
That's good.
And then, of course, and then the growth from there was really scalability. In other words, leading up to 2014 was a lot of figuring out what works and what doesn't work. And when I say that, I don't just mean for me or for Reliant Funding. More importantly, what works for our clients. And so we experimented year over year with different avenues of delivering capital, of marketing, of sales approach, of concept of renewal. And once we felt we had the right formula, it was a lot easier to scale our marketing and our sales team. And then not only that, but to then really invest in our staff internally in terms of training so that we could make them a phenomenal resource for a prospective client rather than just someone that could answer questions about it or be an order taker for that matter. And so we in 2013 began investing heavily in our marketing and scaling marketing and then scaling staff and training. So in that order, it was marketing. I didn't want to scale staff and have this fixed overhead without increasing the prospective clients we would be able to speak with. But so we scaled our marketing dramatically and went from budgets that were 5-figure monthly budgets to 6-figure budgets, low 6-figure budgets. And then we increased our sales staff. So in 2014, our sales staff might have been 10, 11 people. That sales team has grown now. We're well north of 60. And we have 2 full-time trainers on staff that work with them. We go through, everyone that speaks with a client goes through 8 days of full-time, 8-hour days of training in product, training in competitor product, terminology, financial math, systems, etc. And then there's ongoing training. Every week, we do staff improvement training, and then twice a month, we do some analysis of either engagements with clients that went incredibly well, or engagements with clients that did not go as the company would like them to, all with the idea of constantly improving our team. And so these little iterative pieces within sales between 14 and 18 have made a big difference in our ability to convert on the prospective clients that call in. And then again, convert on the clients that work with us, because if they're happy initially, it's easier to keep them happy, versus if they're not happy with the initial experience, it's highly unlikely that they come back. And then on marketing, the scale was a lot of, and continues to be, candidly, a lot of trial and error. So I think it's a combination of marketing, sales, and then ongoing and constant training. And then lastly, you asked for 3, but I will add systems, or what a lot of other people would call technology. But it's such a blanket statement. But we've tried our best to automate and standardize. And I think both of those things are different. But automate and standardize a lot of what we do, which enables, as we market more and as we're able to sell more, for us to put it through without having wild, unpredictable swings in performance of our portfolio or what our clients can expect of us.
Right. Okay. So then to recap, then the drivers over the past 4 years, which of course the foundation was laid the prior years when you finally figured out the the market, the audience, the message. You got to formulate that work, but then you start scaling it up. And that was driven by marketing, which is ongoing, trial and error. Keep what works, discard what doesn't work. Sales, honing your sales process, hiring more salespeople. Ongoing and consistent training, and also perhaps training and as well as review and analysis of your past client engagements. And then technology. Does that about sum it up right?
It does, and it does. And what I want to say is, you as an operator of a business, you're always trying to balance when you make the investment in yourself, and I mean capital investment in yourself, versus the investment, let's say, in marketing or sales. In other words, it's expensive to develop platforms and technology. It's expensive to have a system. You may have to hire analysts and credit policy experts to help standardize and then automate something, and then technology developers to take that policy and standardize and automate it. And it's this constant back and forth of chicken and egg as to when you make the investment. Build the infrastructure too soon, and it's like having a super highway that one person is riding a bicycle down, right? Build the infrastructure too late, and it's a massive traffic jam. And so this throttling of each item, up and down, all four of those items that you and I just spoke of, it's a constant back and forth between 2014 and literally this morning. I was on the phone this morning with all of my department heads and our technology development team as we roll out yet another version of the standardization. So it's an ongoing thing, but it's timing plays a big role in how you tie those four items together.
Right. For 2019, and you've touched upon it a little bit already, but for 2019, say we were to talk again 1 year from today, and you're looking back at what you and your company, what your team has done, what would have to happen to make you happy about the progress you've made? In particular, what problems has your team overcome, eliminated? What opportunities did your team capture? What strengths within your firm were you able to maximize further?
So awesome question, and thank you. And it's something that I try to prioritize weekly with the team. What I would tell you is we have two themes here. One of them is a constant, and one is a 2019 theme. The first is hard work and a great attitude. So one doesn't work without the other. You can have the most joyful, cheerful staff. If they're not working hard, it doesn't go anywhere. And conversely, you can have people that come in every day and work incredibly hard. But if they have a lousy attitude, or they're not positive and they're not passionate about what they're doing, that hard work doesn't produce nearly the same result. So I'm always keeping an eye on making sure that top down, that we're working hard and we have great attitudes. And if there's ever a break in either one, it's not necessarily a scolding. It's more an understanding of what might be causing the attitude to slip or the work ethic to slip. So one is continuity of hard work and a great attitude. And then the other is I want to make it easier to do business with Reliant Funding in 2019. Now, I realize that is such a blanket statement and it's not very defined. But what I want to tell you, I want to reduce the amount of time that it takes for a prospective client to get an offer from us. I want to reduce the amount of time it takes for them to receive funding. And I want us to be predictable and reliable as close to 100% of the time as possible. And right now, I think that we are easy to do business with, but there are too many instances where it takes longer than it should for a client to get a firm offer from us so that they can assess that offer and make a decision. And then once they do, it should be that once they agree that we just ACH that capital into their account. And right now we have a few too many checks and balances that cause a delay. Now, when I say that, it's not on all files, and those delays are hours, they're not days or weeks, but I really want to make it easy. I almost want every client that works with us to proactively say, wow, that was easy. And so what we're doing in the way of credit policy, sales process, even our marketing. In other words, if we market to you, I want it to be your choice as to how you reach out. Do you use the phone Do you go online? Do you download an app? And however you want to reach out to us and get your answer, by the middle of this year, you're going to be able to do that. If you don't want to speak to anyone, you'll be able to get funding from us without speaking to anyone. And so that's a huge objective for us. And then internally, that's an outward facing objective. I want our clients to say, wow, that was easy 100% of the time. And then I described a little bit about how we're going to get there for them. And then the other side is, by making it easier for the client, I'm also working very hard to make it easier for our employees. We have 180 employees. They all work incredibly hard. They're amazing at what they do. And I view it as my job to make sure that they have all the tools they need to do their job better. So part of making it easier to do business with us extends to our own employees. And so some of the technology and the processes we're developing, even some of the policy changes we're making, will make it easier for our employees to be most effective at their job, which then theoretically should lead to more hard work and an even better attitude. And so we're working hard at those things. And then lastly, I will tell you, predictability in our credit policy. In other words, write-off rates and funding that does not, in essence, pay back. I want to be able to identify fraud more effectively than we do today. And I think we're pretty effective, but I know that we can do better. And that's another initiative for 2019.
Right. Got it. So just to recap, 2019, you mentioned a few things. One, it sounds like you would like to reduce the time it takes of your processes, right? Ultimately with the goal of making it easier for your potential clients and current clients to work with you. And you talk about a couple of things, right? Getting the offer more quickly, delivering the money more quickly. Now, I imagine from what you shared with me, it sounds like we're talking about days here, right? Not weeks.
Correct.
Right. Okay. So how long does it take now to deliver an offer to a client after they give you all the information you need?
Well, less than 24 hours. In other words, if they contact us in the morning, we usually have an answer approved, declined, or the terms. If an approval, we'll give them the terms same day.
Oh, okay.
If they come to us in the afternoon, we may be same day, but most typically we're next morning. I'd like it to be that we can always be same day. And we're trying to get our turn time below 1 hour.
Okay, great. And in terms of actually, if you guys come to agreement, everything's good, the client signs on, how long does it take for them to receive the funding?
We're typically next day on funding. Yeah.
You want to shorten out the same day as well?
Yeah. Again, depending on when we get notice. There's certain instances, just because of the way Fed funds and banks work with ACH and or wire, their cutoff times associated with that. But I want the process to be more efficient. Right now we'll have a queue where when someone accepts the offer, it goes through a QC check. We're working to automate that QC, so there is no queue. And that in essence should remove some of the delay. But the other is, I also mentioned predictability or reliability of an offer. There are times where, unfortunately, we may discover a problem with a file after it's been approved and an offer has been made. And while it's very rare that an approval will turn to a decline, it may be that something was either misrepresented or omitted by the prospective client, or we missed something in our underwriting. The automation that we're building in 2019 removes the ability for that to happen and creates a much more predictable or reliable offer. And because one of the things that I know as a consumer, if a business tells me something, I want to know without any doubt that I can rely on what I've been told. Even if it's ultimately my fault, Malcolm, then I feel like the business should have done a better job of asking me specifically what they needed in order to give me my answer. And so I'm trying to be proactive with that approach to what goes on here, and that where we don't ask the question, there's so much that you can obtain online, no violation of privacy, public record information, that we shouldn't have to ask the client, and then the client has to provide to us. So why not make it easier for the client and then in turn make it a much more predictable experience. And so that's another aspect of what I mean by easier to do business with us.
Right, exactly. 3 last questions for you.
Sure.
Say you decide to put a billboard up on one of the freeways near you. I'm not sure if the 405 is a good freeway or not, or the 5, because traffic gets a bit thick there. But say a freeway that's moving quickly. Typically, people only have 6 seconds to read a billboard. What would be your billboard message?
Well, I mean, it would reference, under the gun here, I would say the funds you need, the service you deserve, and reference small business funding. So people don't call us so that they can, get their son or daughter a school tuition, because we really do only serve small business. But the funds you need, the service you deserve.
Funds you need, service you deserve. That's good. And my 2 last questions for you. Who are your ideal clients, and what's the best way for them to reach your team?
So the ideal client is really any small business. And I would say that is someone that has $100,000 in revenue or approaching $100,000 in revenue, all the way up to 10 million annually. They've been in business 6 months or more, ideally 1 year or more. And the only reason I say give that distinction is a full year will give us a window into that cyclical nature I referenced earlier in our conversation, and be in a transactional type business, one that preferably has higher volume. In other words, a contractor is a great client for us, but a contractor that only has one job, that receives one deposit maybe on a monthly basis, that's a lot tougher for us to work with. So a client that has multiple deposits per month, so again, that steady cash flow, is even better for us than someone that has very few deposits. And then the best way to reach us, I would encourage people to look at us online. ReliantFunding.com is the best place to start. Of course, if they choose to call us from there, it's easy to remember the website, ReliantFunding.com. We have toll-free and local numbers on there. We have contact us forms. They can even fill out applications right online and instantly receive a call back, or they can just request a call at a specific day and time, and we'll reach out to them. And we also have live chat on the site. So again, with the idea of making it easy to do business with us, find us online, and then we'll figure out what works best for you based on how you contact us.
Adam, it's been awesome having you on my show today. I really enjoyed hearing how you grew your company so fast.
No, thank you, Malcolm, for the time. I appreciate it very much.
We've been speaking with Adam Stettner, the CEO of Reliant Funding, about his company's rapid growth. For interviews with other fast-growing, high-value sales companies, or to learn how we can accelerate your firm's high-value sales through automation, visit Eversprint.com.